At the end of the Monday meltdown in stocks, I'm on the floor of the New York Stock Exchange with Ben Willis, Princeton Securities Group head trader. Good to talk to you.
Pleasure to be here. Thanks for having me.
Well, it was a messy close, but not as bad as where we opened. What does the action at the end of the day tell you about tomorrow?
It's a great story when we can say the market climbed 500 points from the opening and still closed down 585 points. But actually the close was messy because there was a huge imbalance for sale, $1.3 billion worth of stock, which tells you that's ETF redemptive selling, which is a sign that the average investor is getting out, if you will. That's actually a bullish indicator. We're just not sure when that redemptive selling will end. The other big story that went around, we got a little pop late in the day, was that the Chinese were in fact going to cut tonight. It's a rumor. No, obviously nobody can guarantee that, but that was a little lift you saw when we were down about 600, down to about only 200, and then we fell back on the imbalance on the close.
When you were talking about those sell orders from retail investors, earlier in the day there were institutions that were getting out of the market. Right now, did that selling abate?
It was without a doubt a bifurcated market. The opening, in my belief, was passive ETF and passive money management, quantitative portfolio selling, mostly overseas. Everything we looked at pointed to overseas selling, not American selling. That being said, that's why we had that snapback rally. Once that was out of the way, unfortunately, the American investor sitting at home saw a Dow Jones Industrial Average that traded down 1,000 points, and by 2 o'clock in the afternoon, after rallying back a significant part of the day, we started to see once again redemptive or individual selling. You had a huge pickup, 200% increase in volume at Scottrade. The actual volume on the floor of the New York was over 100% above its average daily trading volume. So there was a lot of activity. From a technical point of view, you could look at that as a capitulation kind of day went with it. But again, a bullish indicator is that generally when retail investors panic like that, that's your time to buy.
What are you going to look for in the next couple of hours overnight and when you get here before the opening bell tomorrow?
Well, I'm in at 6:30 in the morning coming in, and I will look to see what's going on in China to see if they actually have cut, to see if there's any sort of stabilization in the foreign markets. The fact of the matter is the United States marketplace has become a bank account for the foreign investors who can't raise that capital. Over 2,000 stocks did not open in China in a market that was down 8% at one point. So that tells you that they needed to sell something somewhere to raise that capital, and the United States became that bank. It was a very profitable trade for the hedge funds and the traders that could benefit on that opening. They were smart enough to be in place and take those. Easy enough to trade out throughout the day, but going into the rest of the week, we will continue to be driven by the fears of the Chinese slowdown till we get some sort of confirmation from the Chinese to their actual GDP growth. This is not really a function of the Chinese stock market. I think that's being misviewed by most people, thinking, well, the Chinese stock market. The Chinese stock market, in my opinion, is a frontier market. It's not a first tier like at the United States or the FTSE or the DAX. So you need to discount that. It is giving you an idea of their economy. Their economy is what we're repricing, from the belief that it was 7% to the idea that it may be half that. So you cut the GDP in half, you can see what kind of adjustments need to be made in global markets.
What does that mean in terms of how much lower the Dow should drop? Does it have to drop down to levels we saw when China's stock market started to rally?
I'm comfortable. I don't think there's a connection, is my point. In the Dow Jones Industrial and the S&P 500 do have connections, and Apple is probably your best example. And today with Jim Cramer, talking to Tim Cook and the comments he made, Apple sold off originally on its earnings because it made negative comments about their expectations in China. Apple reversed this morning from its lows and traded up to $108 because of what Tim Cook said, saying we're seeing an acceleration in China. That, I think, is indicative. We need more of those kind of stories to settle in, if you will, on the global economy. But I personally believe the correction that I've looked for 3 years happened. You've seen a sector correction that started in some of the major indices, like obviously the energy sector. Those companies have gone through their correction. The question is now finding the value in those stocks that have been sold for no fundamental reason. They've been sold for passive investing, quantitative reasons rather than real fundamentals.
Ben Willis, great to talk to you. Thanks so much.
Thanks.
I'm Rhonda Schaffler for The Street.